everyone, welcome to Oliveboard. So this is the lecture related to bank financial management, and here module A, International Banking, Unit 5, Facilities for Exporters and Importers, we are going to discuss here the MCQs related to Macmillan book. We will learn new concepts and also we will discuss the concepts related to these MCQs. So let's get started with our video. You can put your doubts in the doubt window. Either me or my teaching assistant will answer all your queries. So let's get started with our first question. Yeah, question is saying IEC number is required for. See, what is IEC number and why IEC number is required? We will discuss this now. Basically, IEC full form is Importer Exporter Code, and we can say it is a unique 10-digit identification number granted by the Directorate General of Foreign Trade to an importer or exporter in India. This code is mandatory for all importers and exporters in India. Now, IEC, we understand that importer-exporter code. What is the purpose of IEC? The IEC is basically required for tracking the import and export transactions of an individual or business, or we can say to facilitate the filing of shipping bills or bills of entry to enable the filling of shipping or payments of duties and taxes, also to monitor the foreign exchange transactions. Now, who needs an IEC? Basically, the persons like importers, exporters, manufacturers who intended to export their products, and also service providers who receive payments from abroad. They need IEC. If we see in the question, the given options are import of capital goods, filing of bill of entry with customs, undertaking any export or import transaction, receiving gift from relatives abroad. Basically, IEC number is essential for import of capital goods, filing of a bill of entry with custom, but necessary for undertaking any export or import transaction. So we will mark this option correct here. IEC number is required for undertaking any export or import transaction. Now, here IEC, a code number must for all person, firms, companies engaged in export-import trade issued by the Office of DGFT. Okay. Now, next question. Bank cannot allow export credit for. Here 4 options are given. You can read the options and you can try to evaluate yourself what is the correct answer here and what is the reason behind the correct answer. See, if we say bank cannot allow export credit for like supplies to a manufacturer in India who makes import substitute spare for machineries. Why? Because import substitution basically focuses on barely we can say focuses on reducing dependence on foreign imports and the product are not meant for export but rather for the domestic market, disqualifying them from export credit. And here other cases are mentioned, like if you can see here, options are given: supplies to special economic zone established within the country. Here SEZ are treated as foreign territory for trade purposes, and supplies to these zones generally qualify for export credit since they are deemed exports. Here second is given: supplies to merchant exports where the payment is received in rupees from the bankers to the exporters. Here we can say SEZs are treated as foreign territory. We can say that, but here this is allowed as long as transaction is considered as export and follows relevant guidelines. And supplies to oil mills for export of oil cake where a large part of packing credit is adjusted by sale of oil in the local markets. Here we can say that if the oil is sold locally and not for exports, this could pose a problem. Why? Because export credit can still be extended if the main intent is export. So here we can say that banks cannot allow credit for supplies to a manufacturer in India who makes import substitute spare for machineries. Okay. Here we can see what is Softex form. Softex form we can say an export declaration form basically used for export of goods in non-physical form, where export of software is in the non-physical form. Okay. Now, what is EEFC accounts? Most important, a foreign currency account which can be opened and maintained by any exchange earner, an individual, firm, or corporate. Okay. Moving to the third question. Yeah. See here. An export to a state electricity board covering supply of transmission towers under a World Bank financed project will be called, you can examine yourself here, an export to a state electricity board covering supply of transmission towers under a World Bank financed project will be called. Don't be confused here with the World Bank financed project which is given in the question. Don't be confused. Just try to evaluate yourself. What is the correct answer here? See, basically, the export of transmission towers to a state electricity board under a World Bank financed project will be called as deemed exports. Why? What is the meaning of deemed exports here? So we can say deemed exports refer to those transactions that are not traditional exports but these transactions, these exports are treated as exports for certain purposes such as tax benefit or export incentives. In this case, the supply of transmission tower is not a traditional export, but it is still considered as a deemed export because it is a part of a project financed by World Bank. Okay. Now, what is the meaning of here? We know the answer is deemed, but what is the meaning of global export? Basically, global export refer to the export of goods or services from one country to another country. Global exports are an important part of international trade and are a significant contributor to the economy of many countries. Okay, note this line, significant contributor to the economy of many countries. Now, what is the meaning of merchant exporter? Merchant exporter refers to the export of goods or services by the merchant or a trading company. In a merchant export model, the merchant acts as an intermediary between the domestic producer and the foreign buyer. The merchant may purchase the goods from the producer and then sell them to the foreign buyer, or they may act as an agent or broker and facilitate the sales between the two parties. Okay. Now, what is the meaning of sub-supplier here? Sub-supplier, basically we can say that refers to the exports of goods or services by a sub-supplier. Basically we can say here third-party vendor to a main supplier or manufacturer, who then uses these goods or services as inputs to produce their own products or basically producing their own products for exports. Okay. So, an export to a state electricity boards covering supply of transmission towers under a World Bank financed project will be called as deemed exports. Now, moving to the next one. Here some important terms basically we will see, like PCL, an advance allowed for procurement of goods, manufacturing and shipment of goods for export purposes. Now, what is PSEF? Advance against export bills. That is PSEF. Okay. PCL, basically here we can say that PCL means, PCL is like packing credit loan or pre-shipment finance. Likewise, PSEF we can say that is post-shipment export finance or post-shipment credit. Okay. Now moving to the next question. Yeah. Export credit in foreign currency can be presently allowed to exporters in India at a maximum interest rate of, see, what is the meaning of export credit? Export credit in a foreign currency is like a loan provided to exporters to finance their export activities. The interest rate here on such loans is often linked to an international benchmark rate like London Interbank offered rate plus a certain number of basis points. A basis point is basically equal to 1 by 100 of a percentage point. So we can say that 350 BPS would be equal to 3.5%. Okay. Now here we can take an example. Suppose there is an exporter in India. Okay. There is an exporter in India. is exporting goods to a foreign buyer. Okay, foreign buyer, exporting goods to foreign buyer to finance the production and shipment of these goods. The exporter takes a loan. Okay, takes a loan in foreign currency, like say we can say from their bank. Now here LIBOR rate at the time of the loan, the 6-month USD LIBOR rate is 1.0%. We are taking the currency in USD. Now here, according to RBI guidelines, the bank can charge a spread of up to 350 BPS, or we can say 3.5% over the LIBOR rate for export credit in foreign currency. So here the maximum interest rate that the bank can charge is interest rate is equals to LIBOR plus spread, that is equals to 4.5%. So total interest rate here, the export credit loan in foreign currency is provided to the exporter at an interest rate of 4.5%. Understood here? And we can say that how basically it works, like exporter take the loan at 4.5% to finance the production of goods. Once the goods are shipped and payment is received from the foreign buyer, usually in foreign currency, the exporter can repay the loan. The advantage of the exporter is that foreign currency loans often come at lower interest rate compared to our domestic loans, which helps reduces finance costs and make their products more competitive in global markets. So this is the example, and this is what is the meaning of export credit. So here we can say the answer of this question is LIBOR plus 250 BPS, BPLR 250 BPS, LIBOR plus 350 BPS, or 300 BPLR plus 100 BPS. So we can say here option C is correct. Okay. Now NTP, notional transition period allowed to each bill for calculation of notional due date, and crystallization of export bill is conversion of foreign currency liability to an export bill as per individual bank guidelines in case of non-payment. Okay. Now, packing credit loan, that is PCL. What is the meaning of PCL? We will learn first this. PCL basically is a type of pre-shipment credit provided to exporters to finance the cost of packing and preparing goods for export. Preparing goods for export, like we can say here packing credit is allowed against export bills on consignment basis. See, packing credit loans are typically not allowed against export bills on consignment basis. They are provided for pre-shipment expenses, and the loan is usually secured by export documents for orders. Now, can be allowed to local manufacturer for supply of goods for exports. See, this is also, we can say here, packing credit loans can be allowed to local manufacturer for the supply of goods intended for export, the loan helps cover the cost associated while preparing the goods for export. And is another mode of financing import is not correct. Can be allowed in local currency, not correct. So the correct answer is can be allowed to local manufacturer for supply of goods for exports. Okay. Now, here we can say what is PCFC, packing credit allowed in foreign currency, and what is EBRD, post shipment finance in foreign currency. Yeah, most important question here. An authorized dealer bank branch needs to submit to Reserve Bank of India dash statement on half-yearly basis showing details of import bills where evidence of imports has been submitted within the stipulated time. 4 options are given here. So if we talk about AD, that is authorized dealer, bank or branch needs to submit Reserve Bank of India the bill of entry forwarded, that is BEF statement on a half yearly basis. Now what is BEF statement? BEF statement details the import bills where evidence of imports has been submitted within the stipulated time. Okay. Basically helping the RBI to monitor compliance with foreign exchange regulations and ensure that imports are properly documented and reported. For example, here we can understand this with the help of example. Like there is a company and this company is company ABC. This is an Indian company. Okay. This is an Indian company. Now, this Indian company imports electronics from Japan. Okay. From Japan. Now, company ABC imports a batch of electronic components. They submitted the import documents like bill of entry to their bank. Okay. Submitted. The bank processes these documents and ensures that company ABC had met all requirements and filling the then the bank need to report this import to RBI for the BEF statement. Okay. So this type of BEF are basically filled on half-yearly basis, which shows the details of import bills where evidence of imports has been submitted within the stipulated time. Okay. So here the correct answer is BEF here. Now, moving to the next one. Factoring. Factoring is financing and maintenance of book debt by another party. Now next question is EEFC accounts can be maintained. Most important question. EEFC accounts are exchange earner foreign currency account. Basically is a specialized bank account available in India that allows individuals and companies to maintain foreign currency earnings without converting them into Indian rupees. And basically the purposes of EFC accounts are flexibility and foreign currency accounts or foreign currency earnings, we will say here, basically the correct word earnings. Now EFC accounts can be maintained here for like are meant to help individuals and companies manage foreign currencies earnings. So we can say that here the correct answer is by receivers of inward remittance by way of export proceeds. Why this is correct? Because EEFC accounts are specifically designed for individuals and companies that receive foreign currencies earnings such as exports proceeds. These accounts allow the holder to maintain foreign currency deposits and use them for various purposes without converting them into local currency. So EEFC accounts can be maintained by receivers of inward remittance by way of export proceeds. Moving to the next one. Forfeiting is like financing of export bills on non-recourse basis. Here the question is a financing arrangement where the transaction is financed by a financial institution in the exporter country or any third party based on the arrangements made by the importers on his or his bank is called C. If we talk about buyer's credit, in buyer's credit arrangement, the importer, that is basically buyer, secures financing from a financial institution in the exporter's country or third country. Okay, this credit is typically arranged by the importer or their bank. The exporter receives payment immediately or within a short period, while the importer repays the loan to the financial institution over time based on the terms agreed upon. So we can say that here this is the transaction of buyer's credit. Here the option C is correct answer. Okay. Also we can take the example here, like suppose this is a company A in India wants to import machinery from company B, and this company is in the UK. The machinery cost is like euros. In UK pound we will take, so pound 100,000. Now here company A arranges for this amount buyer's credit from a bank in the UK. The UK bank pays this amount directly to company B. Okay. Now company A will repay UK bank over 3 years with interest. In this way, company A gets the machinery immediately and company B receives payment, and company A repays the bank over time. Understood? What is buyer's credit? So buyer's credit arranged by buyer importer to finance the transaction. Okay. As per extant FEDI guidelines, crystallization of export bills purchased discounted is to be done as under. See, basically first we will learn what is crystallization of export bills. Basically this is the process. Crystallization is the process by with a bank formally recognizes an export bill that has been purchased or discounted. This means the bank into a formal loan or liability on its books, allow it takes to take appropriate actions like seeking payment from the exporter or handling any defaults. Okay, so we can say that like an exporter sells goods worth $10,000 to an importer in another country, and the payment terms are like as prescribed by the each bank as per the arrangement between the bank and the customers. So this is the correct answer here. Okay. So understood what is the meaning of crystallization of export bills basically. Now moving to the next one here. Suppliers credit, we know that suppliers credit, the credit arranged by the supplier exporter for financing the transactions. Okay. Moving to the next one here. Yeah. Factoring is defined as, what is the meaning of factoring? The most important thing, what is factoring? So factoring is like, we can say, a transaction financial transaction where a business sells its accounts receivables like invoices to the third party known as factor at a discount. This process helps the business obtain immediate cash flow instead of waiting for the payment terms to be fulfilled by its customers. And factoring we can define as here, basically it is the agreement between the financial institution and the exporter for purchase of latest book debts and control the credit extended to the importers. Okay. So this is the correct option of factoring is defined as. The option is C is correct here. Okay. And here, bill of entry, a document certified by custom authorities evidencing import of goods. That is bill of entry. So thank you for watching this video. I hope you like this video, and this video will help in covering so many doubts of yours. If you like this video, please subscribe to this channel, like to this channel, and also comment in this video if you have any problem. And if you like this video, so please like and subscribe to this channel. Thank you.